Welcome to the latest video in our Finance 101 series for those new to the workforce or financial planning. In this short video, I will explain how two terms that are often treated as interchangeable, ESG and sustainability, are actually quite different. If you are not familiar with the term ESG, which stands for Environmental, Social and Governance, then you may wish to watch another video in the series titled Introduction to ESG Investing before this one. However, on the assumption that you are okay to proceed, let's dive in. As we become ever more aware of the impact that we have on our planet and see the evidence of it in things like climate change, investing with such considerations in mind has become increasingly popular. There are a number of approaches to such issues that can be placed under the generic term of green investing, details of which are covered in another video in this series entitled Introduction to Green Investing. However, one of the more widespread methodologies today is sustainable investing. Sustainable investors seek to invest in companies that are actively involved in improving our planet or society, or at least carry on their day-to-day business in a way that does no harm. Such investors use ESG as a way to assess companies, highlighting any negative issues that they may need to consider before investing. For many sustainable investors, a poor ESG assessment will be enough for them not to invest in a company at all, regardless of how cheap the company's shares are. However, many core investors that are not investing on a sustainable basis incorporate ESG into their investment process. For these investors, ESG is a set of risk metrics, and whilst a low ESG score may cause them to avoid a particular company, that will be because they do not see the company's share price as cheap enough to compensate them for the perceived risks. We can illustrate how this works using an example of a core investor using ESG to compare two different mining companies, looking to invest into just one of them. Due to the nature of the industry, it is likely that many, if not all, mining companies could have a pretty poor environmental score. After all, digging holes in the planet and extracting commodities is dirty work, however much a company tries to mitigate the damage done. In addition, the parts of the world in which some of these commodities are found have a history of poor working conditions. For example, 70% of the world's supply of cobalt, a critical mineral in the energy transition, comes out of the Democratic Republic of Congo, a country with a poor record on child labour, specifically at mining sites. As a result, such companies may face challenges within the social part of the ESG assessment as well. For a sustainable investor, the almost inevitably low ESG score of both mining companies could be enough to exclude them from their portfolio. However, for a core investor, the ESG assessment provides a very different lens. Firstly, even if both mining companies score quite lowly, largely because of the industry in which they work, the core investor could still invest in the company which scores more highly, perhaps because that company has gone to greater lengths to mitigate environmental damage or has better monitoring systems in place to avoid poor labour practices. As such, the core investor may see the company as being less risky. Alternatively, they may decide to invest in the lower scoring company if they believe that the company's share price is cheap enough to compensate for the extra risks taken. As with all investments, it is a balance of risk and reward, and the price that you pay to invest should always be a key part of that decision. If the shares in the lower scoring company are meaningfully cheaper than the other one, the core investor may choose to invest in the company with the worse ESG profile in spite of that fact. Hopefully, I have explained how ESG is essentially a set of risk metrics that can be used by both core and sustainable investors alike, albeit in different ways. However, there is one further issue that I should bring to your attention. Whilst a proper ESG assessment will be a deep dive into a company, with the report running to many pages, a number of data providers publish a simple score, supposedly to make things simple for investors. We have serious reservations about such scores for two reasons. Firstly, the criteria used to score companies are often highly questionable. By way of example, one of the largest providers of ESG scores allocates 30% of the score related to environmental factors to the depth and accuracy of a company's reporting of its carbon emissions. Please note that is not how low the company keeps its emissions, but how well it calculates them. As a result, we have seen examples of large oil and gas companies that have huge resources to make such calculations, scoring 30 out of 30 on this part of the scoring, whilst a small renewable energy company that does not have such deep pockets scores much more lowly, and yet we all know instinctively who is better for the planet. Secondly, as this sort of data has only been collated for a limited number of years, and even then not by all companies, data providers tend to fill in gaps with estimates, raising another serious question about the validity of the final score. The danger of this approach has been shown when a number of investment funds bearing the climate change label have been found to have larger carbon footprints than the global stock market, something that would be far from clear to a non-expert investor. Therefore, please be wary of any investment fund that claims to use ESG scores to pick a range of sustainable investments for you, as you may not be buying what you expect. I hope that you have found this useful. Should you wish to ask me about anything in this video or the subject in general, I can be contacted at the email shown. Thanks for watching.